Well, as we've been talking about, the FOMC has dropped the target range for its overnight lending rate by 25 basis points. And of course, Jay Powell spoke yesterday at the press conference talking about the future path of rate cuts.
We're thinking of it as essentially in the nature of a mid-cycle adjustment to policy. I'm contrasting it there with the beginning, for example, the beginning of a lengthy cutting cycle.
So we're not at the beginning of a lengthy.
That's not what we're seeing now. That's not our perspective now or outlook.
Joining us now, Mike Schumacher, Wells Fargo Global Head of Rate Strategy. Rates have been going a little haywire over the past couple of sessions. In the wake of his comments, the thinking was they're not going to cut anymore. Then today, the thinking seems to be, at least if you look at what's going on in rates markets, oh yeah, they're going to keep cutting. I mean, was it a fail by Jay Powell? Did he not communicate clearly, or is the market just not ready to hear what he had to say?
Let's see, it's the first rate cut in 11 years, and he sort of walked it back. So that was a fumble. I think that's pretty clear. Now, the view that they're done cutting, that's too extreme. We think there's at least one more move. Who knows, maybe there's something beyond that. But the problem is the market was teed up for 4 moves by the end of 2020, and that seems pretty unrealistic. Sure, things can change. Who knows what happens from Brexit? 400 and some odd million for drugs, give me a break. But can't really tell how that plays out, or the trade situation. But still, the Fed's view right now is pretty unlikely that it's going to be a long cycle. So yes, we do think Powell fumbled. Are they done? We doubt it.
Well, what do you make of the move they made that we don't talk a whole lot about in regards to, one, ending the roll-off? I realize that was only 2 more months to go, but also, the interest they pay on reserves that the banks have.
Balance sheet was a sideshow. I agree with that point, Adam. Yes, they took it down, they ended it quickly, but it's really just to avoid having some sort of really miscommunication, if you will, with one cutting and one tightening measure in place. So I would tend to ignore that. And as far as reducing the rate paid on excess reserves to banks, the key thing here is they reduced it by only 25 basis points, so in line with Fed funds. And what's been going on is for a lot of banks, the easy route is simply to put money at the Fed. We'll pop money over at the Fed. We get this rate now, which is down 25, so it's 210. That's really awfully good when you compare it to Treasury yields. Why go to the trouble of buying a bond if you can simply call up Mr. Powell and friends and say, here's some more cash, give me my 210. There was a theory in the market it might go down by more than 25. That didn't happen.
Okay, the market really missed this. The Fed is creating the conditions to pump money into the real economy. This is fundamentally a good thing. Think about what happened yesterday. Traders sold off 1.5% off equity markets because they basically missed the real story. I can't believe that we're not talking about this more in financial markets. I mean, that's one of the reasons why the bond market.
So what's the real story then?
Yeah.
What do you mean?
Okay,
The interest paid on excess reserves.
basically it's forcing the banks to put that money to more productive use rather than sitting on reserve at the Fed, which we've been doing for over a decade. This is actually a really good development. As long as the economy continues to move around 2%, I think it's safe to say Fed can actually go further on this.
But you can't blame market participants for being confused as we've been discussing. And Mike, I want to ask you, he talked a little bit about, there might be more, actually there might be a hike even this year. He said that. And can you remember a time in history where we've kind of had a situation like this where it's so hard to read the tea leaves?
It's really bizarre, frankly. Yes, theoretically there could be a hike, but why would you say that? Why not say, hey, it's the first cut in a long time, enjoy the rate cut. If we hike, we'll just deal with that some other day. But that's not what he said. So it's puzzling. I'm not sure why he had to come back with that comment. It seems like it was a miscue from our perspective.
It was a failure to communicate, right? Let's just call it
what we have here
is failure to communicate, or as Led Zeppelin once said, communications breakdown, right?
Yeah.
Hey, the other thing is when you go around the banks, there's a lot of young kids who've never seen a rate hike in their career. That doesn't implicate anybody around this table. Yeah. But we were getting we were getting questions yesterday. Really, people just never seen it before.
Oh, that's interesting. I didn't even think about that.
So Mike, when you hear what Joe is saying about sort of the real story here, that the Fed is trying to push banks' money in a different direction, do you think that's going to be successful? And what does that mean for your strategizing at the end of the day?
If the idea is to get banks to lend more, you've got to say, why is loan production relatively weak? Is it because banks are actually not supplying a lot of loans, or there's not much demand? I'd say it's more on the demand side. Banks have been willing, but they've been putting money at the Fed for a while. And if you think about some of the simple choices, you can break it down into 3. We give money to the Fed, we get this interest on excess reserves. We go out and buy conservative bonds, treasuries, mortgage-backed securities, what have you, or we make loans. Well, making loans really hasn't been doing as well, so it's not at all clear to me that simply taking this interest rate on excess reserves down by 25 basis points is going to spur a ton of lending activity. I doubt it, frankly.
Real quick, the best part about financial earnings this quarter was the consumer lending business and wealth management. There are plenty of places to put money. I just don't buy that.
All right. Well,
Consumers.
that's what makes a market.
Right.
Thanks, guys. Mike Schumacher, Wells Fargo Global Head of Rate Strategy.